All right, good morning, everyone. It is 8:29 in the morning of August 17th, 2022, and this is my pre-market strategy session. So what we have going on today is I have the SPY up, starting out with the proxy to the S&P 500. It's an ETF. Okay, and the title of today's video is Press the Shorts or Buy the Dip, BTFD. So, and we'll just take a look at what's happened here in the past. I don't know, let's see how long ago it was. It was, I'll call it since June. So here we are 6 weeks later, and the market has put in quite a move to the upside, 19.21% to the upside since June. What happened in the past 6 weeks is something that would happen typically in a good year, a quiet and good year in the economy, and you could get 19.21% returns on the S&P, and here it is in 6 weeks. It's made that move. Well, okay, and taking a look at the move here, put in this this bottom doji here, back in June, and then after that, made a run up, couldn't quite hit it, and came back down a little bit lower, and it was looking like it was going to be really bearish, and then boom, went up here, slight pullback, boom, a little bit of a consolidation zone in the same area as over here, happened over here, and then whoosh, right? So nothing goes up in a straight line, of course. And so here we are after another 5 days of the market going up. There's bound to be a pullback, right? At least a pullback. And really the big question on everybody's mind is this the start of the next leg down in the bear market? Actually, let's see if the SPY is still technically in a bear market here. Hang on a second, let me zoom out, get rid of all these scribblings here. Let's zoom out real quick. So here's the top up here, and here's where we closed yesterday, and there's a 10.48% downside right here. So the SPY may survive here. Hard to say exactly. There's bound to be another leg. And I don't know if we want to call it a leg down, but dip or a move down here after this incredible move and after these past few days. But is this the start of the next kind of real downward trajectory, right? There are some people who say yes, this is the there are a lot of voices who are saying yes. This is the Bank of America, Merrill Lynch, Goldman Sachs, the World Economic Forum. I've forgotten the list of financial companies that have put out warnings on the economy, saying this is going to turn into one of the worst recessions like ever, could be going into a depression, so on and so on and so on. There are a lot of people saying this is expect the next 5 to 10 years to be just terrible, right? It's possible. I mean, it's possible that could happen. And so saying that this spot right here is the next spot to press the shorts, it doesn't come without some merit. There are plenty of very influential voices saying things like that. So why would I try and argue with it? Well, I don't. I just trade the chart that's in front of me. So today here, we'll take a look here on in the pre-market. You can see things are selling off a bit here. I wonder if there's some kind of news at 8 o'clock. Let's see. Today's Wednesday, right? It's Wednesday. I don't know what kind of economic news came out. Let's take a look at just sort of what the Yahoo is saying. And see what the headlines on Yahoo are. Target earnings miss. CEO looks to leaning into holidays. Our IRS's RMD rule change could make your RIA more valuable, whatever. Yeah, here's Mr. Big Short. Michael Burry makes a shocking decision. Whatever. Blah, blah, blah. All right. Well, so looks like it's going to be a pullback here. It's normal, so it's looking bearish. The tech ought to get hit harder than the Qs. Oh yeah, actually, let me go back to the SPY here, and something else about the SPY here. Let me show you the technicals here real quick. So there's a support line, and right there. So this line, I've had this line in for, I don't know, 2 or 3 weeks, something like that. I've seen it on a lot of different charts of people that I pay attention to and so forth. And I didn't put it in. I just didn't feel like putting it in. I was kind of like, whatever. So here it is, though. And so yesterday, yeah, the SPY poked up above this resistance line right here, and then fell down below it for the close. And now here we go. I mean, it's normal. It bounces off of the bottom and then goes off the top, and comes back down again. So let's suppose for a moment it comes back down to support. It's a 7% move. Suppose it comes down to support by, I don't know. We'll call it by the beginning of September. Then there'll be a negative 5.8% move. So okay, and then if it starts its next leg up, that'd be great. Really, I tend to think though that it's going to remain bearish, and here's, so here's the 10-year, 2-year difference, the delta, and it's negative. So right now you can get 454 more points for putting your money in the 2-year than you can in putting your money away for 10 years. So if you buy 2-year bonds right now, you'll get a higher return than if you buy 10-year bonds, which is inverted. It's backwards. And it's going deep, and it looks to me as though it's going deeper. It's going further down. Very interesting, very, very interesting. And here we have the VIX. The VIX dropped down below this resistance support line right here, and it might poke its head back up. You're not supposed to chart the VIX. Don't pay any attention to the charts on the VIX, but I can't help it. I do it anyway. Getting into a little bit of a down portion on the VIX here. I'd like to see it consolidate here and then continue to go lower. And keep in mind that as the 10-year, and a lot of people are paying attention to this, and it makes sense to pay attention to it, but just keep in mind that when the VIX goes negative, it's not until, so here's not the VIX, but when the 10-year, 2-year goes negative, it's not until it starts to normalize that we get the sell-off in the market. So here it is in 1990. We had there's a sell-off in the market in 1990. It's not until the 10-year, 2-year really starts to stabilize and normalize that we get the sell-off. Here's 2001. This is the tech bubble. And here's the 10-year, 2-year spread. And then once it starts to normalize, really starts to get stable and normalize again, we don't get the sell-off until here at this point right here, the beginning of January 2001. And then again in let's see, May of 2007, the yield curve was inverted for quite a long time. That's something else to keep in mind too, is that here we are today. It's diving down. It's diving down hard, right? But it could do this, and it could stay this way for a considerable amount of time. So, for example, from February 2000, I'll call it from January 2006, all the way until May of 2007, the yield curve stayed inverted, or it didn't stay inverted. You can see here, actually, there are a few weeks here where it came back up again. It did poke its head back up, but it was doing this sort of inverted dance here around zero for nearly 18 months before the yield curve started to normalize again, and this is where the crash happened, right in here. Again, in 2001, we'll call it January of 2000 to December of 2000, a year. So the yield curve was inverted for a year. In 2001 was inverted for 18 months in 2007. And back here in 1990, from November of 88, to 28 May 90. Well, that's 2 years of the yield curve being inverted or really close to zero, going back and forth between inverted and non-inverted. And it wasn't until this point right here in July of 1990 that the stock market really started to roll over and tank. So today's a good day to, most likely is going to be a good day to put on some shorts, press what shorts you have, and let it ride for a couple days. We'll see, though. There's nothing for certain. I'm going to use the relative strength indices strategy for my entries. All right, everybody. Good luck out there. Keep your risk tight. Click like, share, subscribe, leave a comment, tap the bell, and I will see you on tomorrow morning's strategy session. I am out.